So it's been an interesting 2-3 years in the uranium space. How are you faring
Uh,
up? How are you?
yes, I was going to say that's a delicate way to put it.
It's been tough, right?
Yeah, look, it's been tough. I would say that we're blessed with the project because if I had to wake up every morning and look at a project that needed $65 uranium to be able to move forward, I think it'd be a pretty depressing place. $65 uranium is going to be here, but it is a question of when and on what trajectory, and so I think we've actually been really blessed, and we've actually quite excited about our story, despite the market uncertainty and despite the fact that we keep seeing record low prices, because even today we could make a very good return at Phoenix, and that's what gives us so much energy around advancing the project now, even if the cost of capital is high, because we have to look at how will we make money in this cycle. And the way that you'll truly generate a return for your investors is by producing the pounds, right? Or at least having visibility to those pounds coming out of the ground. We're not looking for the rising tide of an exploration company in this company. We're looking for a proper re-rate from developer to producer. And we believe that positioning ourselves that way right now will give the investor maximum torque to whatever happens with the commodity price, but with this beautiful insurance policy that says even if the commodity price doesn't go to $65, the project still goes ahead and still gets built, and you still get the developer re-rate.
But let me ask the question, what do you need to see the price get to incentivize you to, because you don't want to get into production for break even, right? No one wants to do that, whatever that number actually turns out to be. What's the number you're looking for from the market?
Well, we break even at $9 US.
Sure, but what do you need to get going here? I mean, what are you telling me? I would get in production tomorrow if you get the finance? Is that what you're saying?
Yeah, you'd argue that that's a possibility. I think for us, the biggest question will be the cost of capital for the build. Are we comfortable with the uranium price that's built into our equity value, or the cost of debt that's available, and how costly is that, and will it be cheaper if the uranium price is higher? I don't really see the uranium price driving the actual decision on the asset so much as it does informing the cost of the capital.
But for
I
sure.
think it can have a good return, and the shareholders would do well. It's a question of how well with the cost of capital.
Okay, so remind me about your capex cost based on your PFS.
For Phoenix, to get this started, it's around 325 million Canadian.
Right.
And
Okay.
you have to remember, like when we look at that, we've got a slide that gives you sort of that cascade of production.
Yeah, I got it
We,
here.
we have not gone and maximized NPV, right? We've actually gone and put together something that's commercially reasonable. It's if we wanted NPV to be as big as it could be, we'd have Griffin and Phoenix starting at the same time. We'd spend $1 billion in capex up front, and we'd have 15 million pounds a year of production. What we're trying to do is make it realistic, right? And so what we've done is we've said, look, Phoenix makes money today, does not require higher uranium price. Capex is low, 325 million Canadian. Let's build Phoenix. Let's use that cash flow to fund Griffin as a second stage. And let's use the production from Phoenix, which doesn't need contract cover to make money. Let's use that production to incent the utilities to sign long-term contracts for the Griffin operation, right? The utility looks at it and says, how do I sign a contract for an asset that doesn't exist? I need my uranium. The best way to sell to them is to have uranium production before you sell them the contract. And that's really what we're trying to do with this, right? And that's why the plan has been put together this way, commercially reasonably. And that's why, important thing, we think raising $300 million is a totally different task than raising 1.5 billion, and that 300 million we believe is available in a moderate to almost today's uranium market. We don't believe it requires $50, $65 uranium to be able to access that kind of capital.
Can we segue off of that just very quickly? There's a lot of talk in the market about mergers at the moment, and you're talking there about raising 1 billion, 1.2 billion, 1.5 billion bucks. And there's a few names that spring to mind there, obviously, which is, I think, bringing on this talk of mergers. Do you see some of the other players in the Athabasca Basin needing to come together to kind of get this funding in place, or should they be smarter like you and say, hey, let's bring that capex down to something more manageable, get into production, proof of concept, proof of route to market, and get going? Do you think their plans are too big?
Well, look, I think there's a lot in that question. We made a purposeful decision to design the project this way.
Yeah.
Part of it is that if we had brought all that Griffin production forward and maxed out our NPV, it would lead us into a path where we'd have disappointment potentially ahead for our investors, because it'd be difficult to realize on that NPV, right? You'd have to be spending $1 billion, raising that money, building a shaft and an ISR operation at the same time. It's just not realistic in our eyes, and it's too high risk, right? So let's take a more measured and sensible path. That's what we've done on the capex. We do think lower capex is a relevant thing right now. In terms of M&A, if I were to step back, I mean, I'd look at Cameco, right, and Orano. These are the big boys in the Athabasca Basin. They both have declining production profiles. Cameco has a great stable of assets between McArthur and Cigar. These are high grade and large. But at the end of the day, even they will admit, and I watch many of their investor presentations and attend many of them, but even they will admit that the time is actually now or yesterday to be advancing the next phase of mines in the Athabasca. Now, they can't justify it when they have producing assets that they're curtailing, but even they will admit that today is the time to actually be moving these assets forward if we want to have that new production fill the gap that's emerging in our space in that 2024, 2025 horizon. So ultimately, I think when you look at M&A, it's Cameco and Orano that have to look at how will they replace their production, how will they grow to meet market needs. They don't have other assets that are queued up. Now, McArthur's a great asset. It'll come back online, and that's a reality. But they need pounds even beyond that, and they admit it. And so I think there is reason to understand that there will be an M&A slant for many of the players in the space. I don't see it happening now because you've got McArthur shut down temporarily. It'd be a very difficult thing in my mind for Cameco to go out and acquire assets when they have truly the world's largest and highest grade uranium mine parked for the time being.
Okay. Do you see yourself as a takeout target? Are you gearing yourself for that, or do you genuinely want to get into production?
Look, I don't see a takeout anytime soon, and so I think it'd be a bit risky for us to develop or advance ourselves as a takeout story. We really are laser focused on building the project, and we built the team to be able to do that.
Are there any other projects in the Athabasca Basin, excluding your own? Which projects in the Athabasca Basin do you think that you would like to work on?
Well, look, I mean, NextGen has been hugely successful. They have a very large high-grade uranium deposit that no doubt will be a mine at some point. So it's hard to answer that question without talking about Arrow. It's a great deposit, and they're a good company. So we wish them the best, and I certainly wish that I was involved in that company before they found Arrow, because then I'd have a lot more money in my jeans than I do now.